Opendoor Technologies, ticker OPN, is trading live right now at $8.16. It's almost perfectly flat on the day, down just a fraction of a penny. But that stillness is deceptive. This stock has been on a tear, and today's session has already seen it swing between $8.04 and $8.55 on very heavy volume of over 48 million shares. The expectation for Opendoor is that it's a broken real estate company, a prime victim of the high interest rate environment, just burning cash. But the reality is that this stock has become one of the most explosive and controversial battlegrounds on the market. It's up over 350% in the last year, and the tension between what this company is supposed to be worth and what the market is paying for it has reached a breaking point. What you're seeing isn't just a housing play. It's a high-stakes war between fundamental analysts and a retail army that believes a massive squeeze is imminent. Most investors see Opendoor and think iBuyer. They see a company whose entire model relies on buying homes, holding them on its balance sheet, and reselling them for a small profit. A model that gets crushed when mortgage rates spike and the housing market freezes. The common belief is that this is a simple, binary bet on the Federal Reserve. If the Fed cuts rates, Opendoor lives. If they hold, it dies. But this view is dangerously simplistic. It misses the fundamental shift happening inside the company, and more importantly, it misses the structural powder keg that has been built within the stock itself. The real story isn't just about interest rates. It's about a company desperately trying to pivot to an asset-light, AI-driven marketplace, while 25% of its entire public float is being held short by institutions betting it will fail. Let's look at the recent action. This stock doesn't trade, it explodes. Just a few days ago, it ripped 15% in a single session on a cooler-than-expected inflation report. Why? Because the army of traders watching it pounced on the first hint of a macro tailwind, using it as fuel to attack the short positions. 8 days ago, it jumped over 5% when Morgan Stanley, in a stunning move, upgraded their price target to $6. Now, that $6 target is still well below today's $8.16, but the previous target was just $2. That's the kind of momentum that gets attention. This volatility is the new normal for Opendoor. It's become a proxy for high-risk sentiment, reacting violently to any piece of news that could support the bull case or force the shorts to cover. The heavy volume we're seeing today, even on a flat day, isn't boredom. It's consolidation. It's the market absorbing the recent gains and coiling for its next move. This is a technical trader's dream and a fundamental investor's nightmare, with the price action completely detached from the P&L statement. This brings us to the most critical element of the Opendoor story right now, the short interest. This is non-negotiable for anyone looking at this stock. According to the most recent data, a staggering 25% of Opendoor's float is sold short. That means for every 4 shares available to trade, 1 is a bet that the price will go down. The total number of shares shorted is over 106 million. This is an enormous, crowded, and dangerous bet. The short seller thesis is simple and, on the surface, very compelling. They look at the company's fundamentals, a TTM revenue of $5.2 billion that produced a net loss. They see the $1.4 billion loss in 2022. They look at analyst consensus fair value estimates that pin the stock at $1.71 or even $1.30. They see a company that trades at 1.2 times sales in a sector where that's considered expensive for a company with negative margins. They believe the 350% rally is a speculative bubble, a meme stock frenzy that has disconnected from reality, and that eventually gravity will win. But here's where it gets complicated. That 25% short interest creates its own reality. When that much of a stock is shorted, it becomes a ticking bomb, as many traders on forums like TradingView and X have called it. The days to cover, or short ratio, is approximately 2.3. This metric estimates how many days it would take for all the short sellers to buy back their shares based on average trading volume. A ratio of 2.3 isn't astronomically high, but combined with the 25% float, it signals a very crowded trade. If a catalyst arrives, another hot inflation report, a positive earnings surprise, or even just coordinated buying pressure, all 106 million of those shorted shares represent forced future buyers. This is the classic setup for a short squeeze. The shorts rush to the exit at the same time, but the door is too small. Their buying to cover their losses creates a vacuum, sucking the price higher, which in turn forces more shorts to cover. This is the monster move the bulls are waiting for. So what's your take on this setup? Is a 25% short interest a sign of smart money conviction, or is it a dangerously over-leveraged bet that's about to backfire? For retail investors, it's vital to know how to navigate this. First, you can track this data yourself. Short interest is updated twice a month and is available on sites like Fintel or through your broker. Second, watch the borrow fee rate. While we don't have a live number, a 25% short float almost guarantees the cost to borrow shares is high, putting pressure on the shorts to close their positions. If you see that rate spiking, it's a sign of panic. Third, understand the risk. Playing a short squeeze is not investing, it's high-stakes speculation. You are betting that you can get in and get out before the music stops. The same mechanics that cause a squeeze can unwind just as quickly, leading to a catastrophic collapse. Never, ever risk more than you are prepared to lose entirely. This is precisely the discussion dominating retail investor forums. You have one camp posting technical analysis, pointing out that the stock is testing its 50-day moving average, calling it a perfect technical spot to buy the dip. They're adding to positions above $8, calling it a pure speculative play. Then you have the other camp pointing to the same analyst reports as the shorts, saying, I sold at $8.88 and that a big correction is coming. There's even a narrative that retail interest is waning, that trading volumes are slowly declining from their peak, which would be a bearish sign. This conflict is the heart of the matter. So who is this company that's inspiring such a war? Opendoor, at its core, is the company that tried to digitize home flipping. Its original iBuying model used algorithms to make instant cash offers on homes, sight unseen. It would then do minor repairs and try to resell the home weeks later for a profit. It was a model built for a 3% mortgage rate world where home prices only went up. When rates shot to 7 and 8%, the model broke. They were caught holding thousands of homes that were losing value by the day, leading to those massive billion-dollar losses. That is the expectation, but the reality is that Opendoor is in a race to reinvent itself. It hired a new CEO, Kaz Nejatan, and more recently, a new operations chief, Gang Lei Grease, both from Shopify. This is a deliberate signal. They're trying to pivot from a capital-intensive home flipper to a capital-light real estate marketplace. They want to be the tech platform, the AI engine that partners with agents and offers services, taking a fee rather than holding all the risk on their balance sheet. In Q2 of this year, they even posted their first quarter of adjusted EBITDA profitability since 2022, a small but crucial sign that the new leaner model might be working. This sets up the final conflict. The future outlook for Opendoor is a true clash of narratives. On one side, you have the fundamental bears and the short sellers. Their case is that this pivot is too late, too little, the company is still burning cash, the housing market remains locked by high rates, and the stock's $8.16 price is completely untethered from its $1.71 fair value. They're betting that the company will have to dilute shareholders by raising more cash to survive, and the stock will collapse. On the other side, you have the bulls. Their case has two parts. First, the fundamental part. They believe the pivot to an AI-driven asset-light marketplace is being overlooked. They see the Shopify executives and believe Opendoor is becoming a true tech company. They'd point out that on a price-to-sales basis, it's actually cheap compared to Zillow. The second and more dominant part of the bull case is the squeeze. They see the 25% short interest as a guarantee of future explosive upside. They believe the shorts are trapped, and any good news, a Fed pivot, a strong earnings surprise, or even just sustained buying pressure, will trigger a run that could send the stock into the double digits far past its 52-week high of $10.87. Comment below with your price target for Opendoor by the end of next year. Are you in the $1.71 camp or the $15 squeeze camp?